Hello and welcome back to another Stock Market Now video. It's a surprise that the GameStop stock price would go up during this pandemic. It's even hard to believe that the cause of this price spike is almost done by the Reddit community. In this video, we are going to explain how WallStreetBets make the price spike at the stock market. This is Stock Market Now. Before we continue, do make sure to subscribe to the channel and give this video a big thumbs up so that we can create more informational and educational videos for you to consume. With that said, let's get right into the video. First, there are three things that we need to understand. The first is the subreddit WallStreetBets, GameStop, and the basic understanding of the stock market. Now, if you are using Reddit, you might see this subreddit called WallStreetBets on your feed. Now, WallStreetBets is a subreddit that discusses investing in the stock market. It started pretty small, but now it has almost 2 million subscribers. This subreddit is blowing up. Now, I would say, but not in a bad way. All you can read here are memes and insane lingos. And the only thing that you need to know about GameStop is that it is a company in the USA that sells video games. So, stock market. Now, shorting. Shorting is the only thing you need to know about this stock market. Now, shorting is when you think that the company will go down, and you are going to borrow that company's stock from a broker and promise them to pay them back later. Now, let's make it simple. For example, I think that the Apple prices will go down. Let's say they cost around $2, then we are going to approach the vendor and say, "Hi, can I borrow an apple from you? And I will pay you an apple later." Now, I will sell this apple to another guy for $2 and then wait for the price to change. And let's say that the apple price will go down from $2 to $1. Now, I can buy 2 apples with the $2 that I have, and I can now repay the apple that I borrowed from the vendor earlier. Now, the vendor got his apple back and I gained $1. In layman's term, I just shorted apples and replaced apples with stocks, then you will get the idea. Now, remember these two things in relation to shorting. First, you need to pay an interest rate on your short positions because you are borrowing something. Second, short interest can be higher than 100% of available stock. Get it? Now, for example, if I borrow an apple from vendor A, then sell the apple to vendor B, then there's this one guy that will borrow the apple from vendor B, then sell it back to vendor A. So right now, we are back where we have started with 1 apple to vendor A. But now, there are 2 apples that are owed by the vendors. Now, do you now get it? Now, let's have this story from 2020. Brick and Mortar is a game company that owes GameStop. Now, when the pandemic started, GameStop experienced some bad months and revenues decreased greatly. At the same time, the stock price of GameStop fell at $4 per share. Now, GameStop lost their big international investors because of this thought that GameStop will go on a bust. As a result, hoping to see it bust, they shorted GameStop stocks. However, there are good things that they didn't expect to happen. Now, first, in mid-August of 2020, the founder of Chewy, Ryan Cohen, started buying GameStop shares. By December of 2020, VC Ventures, a company of Ryan Cohen, bought about 9 million shares of GameStop, and that composes 13% of GameStop. Now, in January of 2021, Ryan Cohen, the founder of Chewy, and Alan Atal, the previous CEO and CMO of Chewy, and Jim Grube, the previous CFO of Chewy, now they were all appointed as part of GameStop's board. Chewy is an online pet food retailer. Now, GameStop gained an advantage. They now got a billionaire investor that had experience in running e-commerce companies, the business model that GameStop needed to turn to. Now, secondly, in November, the PS5 and Xbox Series X was released, which marked the new beginning of the console cycle. Now, this is good news for GameStop. Now, third, GameStop signed a deal with Microsoft, which gave them a share of all Xbox's digital revenues. Now, this is really good for GameStop. Now, what about the stocks? It seems in this period, there are 2 important things that have happened. Now first, the organizations that shorted GameStop stocks buy more short positions and defend their first shorts. They saw that the stock price of GameStop increased. They tried to hold it and buy more short positions. On January 11, there were about 4 million short positions bought, despite the announcement of Cohen being part of GameStop's board. Now basically, there were a total of about 71 million short positions bought by organizations. Now, GameStop only has over 69 million floating shares. Now this is where things start to get even more crazier. Remember, you can have more short positions than the actual number of stocks. 20% of GameStop shares were held by insiders like Cohen. Now insiders cannot sell their stocks easily due to regulations and rules. So no one can buy that shares, and there's also the same amount of stocks held by organizations who don't normally trade actively. Now this leaves a total of 20 to 30 million actively traded stocks, and there are about 71 million short positions that all need to buy stocks. Now that is a lot of demand for a very limited supply. So WallStreetBets realized this, and if they bought back the stock and held this, they are determined that the price will go up. This is known as the short squeeze, where people with short positions buy into a stock and try to cover before the price will go up too much. Now to simplify things, they are gonna buy apples to return to vendors before the price increases. Now they are losing money, but covering now is better than losing money more later. But there aren't enough stocks to play around, so this forces the price to increase. Remember, it costs money to short stocks because of interest. They need to act fast. Now this is the same thing that happened to Volkswagen in 2008. They shortly became the world's most expensive company. That's what GameStop investors did. GameStop stock price rises from $5 per stock in November to $20 per stock in December, and up to over $40 in mid-January, with a sweet $150 peak. Now that is a huge increase. People on Reddit did make a lot of money out of it, while short sellers lost big. Two big names involved in this are Andrew Left from Citron Research, and Melvin's Capital claims that GameStop stock price will collapse to $20 when it was $40. Now he also put up a YouTube video about his assumptions and reasons. He was wrong. Melvin Capital is a hedge fund that has short positions from GameStop. They needed to be bailed out by other big companies, which clearly is bad for them. Now here are 3 things to take note. First, it's unclear whether the short squeeze has fully happened yet. Now there are a lot of short positions that need to be covered. No one is sure how this will turn out, whether there is enough liquidity to cover the short positions around the present price, or the community will hold and force the price to go up. Secondly, if you will see this on the news, it will be talked about as a mental Reddit investors ruin the market. Now there are 3 things that need to be worth talking about right here. WallStreetBets don't hold much sway over the market because it is an internet forum, not an organization. The market is not rational beforehand, but the hedge funds were able to manipulate it, and this is not a clear manipulation. Some of GME's rise is a result of speculation, but there is a good argument that it was undervalued and overshorted. Thirdly, it is a very good thing that people are able to get into the stock market and earn money out of GameStop stocks. And this makes it difficult for hedge funds. Know what you guys think? Let me know in the comments below, and I will see you guys in the next video. Peace. But before you go, make sure to subscribe to the channel and give this video a big thumbs up. This is Stock Market Now. We'll see you in the next video.